Morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. It has been a big week for economic news and economic data. This morning, we woke up to lots of tariff news. There's a lot going on. A lot to unravel. It seems like we need an expert to help us with this, and luckily we have one this morning. Professor Christian Lundblad from UNC Kenan-Flagler is going to be with us in a moment to try to provide some clarity if there is clarity to provide. He's going to give a presentation of 15 to 20 minutes. Then he's going to take questions from you all, the audience. You can submit those questions at any time during the presentation, starting now, using the Q&A function at the bottom of your screen. If you're a member of the media, please let us know in your message, give us your organization name so that we can make sure that we get those questions answered. If you're with us by phone this morning, you can still participate in asking questions. You can email it to me, Rob_Knapp at kenan-flagler.unc.edu. We are going to be taking questions up to about 9:30. We will try to land on the mark. We'll see where we go, but that is our plan. So you know what you need to know. You've got that third cup of coffee. I think we're ready to move on to this. Joining us this morning is the Kenan Institute Research Fellow and UNC Kenan-Flagler Professor, Christian Lundblad, who will try to provide us with a little CLARITY. Sock it to us, Christian. Good morning. Good to see you.
Good morning, Rob. Thanks. Let me share my screen here. Okay, everyone. Well, that's a tall ask to deliver some clarity on this particular morning. I think what we got this morning was a pretty stunning labor report, certainly on the downside, things that are looking significantly more challenging than expected. And not only did the July read come in below expectations at 73,000 jobs in the non-farm payroll, we had a modest tick up in the unemployment rate. And I think most significantly, you can look at some significant downward revisions. So that healthy read we got for the June report of 147,000 jobs, that's been revised down to 14,000. So collectively, like in terms of what's changing our understanding of where we were, the collective negative revision in expectations, that's well in advance of 200,000 fewer jobs than we thought we were going to be creating or had created in the last go. Pretty significant, right? So let's kind of walk through a little bit, for lack of a better word, the murk. I don't know what else to call it. And then give you a sense of the challenge that our policymakers are facing in an environment like this. So again, here's sort of the non-farm payroll number that we just got. You can see the most recent one at the bottom right of this, as well as the significant downward negative revisions. So that's pretty notable. There's a couple of bright spots in there. Healthcare kind of continues to show some resilience, but broadly you can see a pretty significant decline. And far fewer jobs than we imagine. And collectively, this is just a legitimate, weaker signal of a labor market. Though I will offer one caveat here, which is separating out some supply and demand effects here remains challenging. And so what do I mean by that? Well, not only is this clearly an indication of some weakening that I think we appreciate anecdotally and are now starting to show up to some degree in the labor market data about firm slowdown and sectoral slowdowns that we can see here and there. There are also really significant questions about labor supply. We saw labor force participation slip a little bit. We've seen obviously some significant news stories about immigration and the like. And so put that together and it creates a kind of complicated setting about like what pieces are moving what. And in that spirit, I want to highlight this number actually, which is the unemployment rate. And this is the measure actually that Chair Powell of the Federal Reserve asked us to particularly scrutinize in his press conference. And what we see over here is the unemployment rate sort of ticking up modestly. That is a slight tick from the previous month, but it's not, a drastic increase. And that's a little bit the complication in some of the pressures of supply and demand that we might see. So while the job growth creation numbers that we see in the previous slide, are definitely notable and deserving of our attention, this one is suggesting a bit of some additional softness here, but it's not as though we're like clearly in recessionary state. I mean, you will not see an NBER recession. Those are the folks who actually, describe what is a recession in the historical record. You're not going to see that in the absence of a massive increase in this number. And so we're just not there yet, to be clear. And again, as I said, our Fed Reserve Chairman has asked us to particularly scrutinize this number, and it's reinforcing the idea of some weakness, but it is not dire, at least not at present. I think we ought to acknowledge that. So what else did we learn? We learned a little bit of a softening in labor force participation. What is interesting, and it is sort of complementary to all of this, is the other piece that we learned is that average hourly earnings actually increased slightly. And so those were up 0.3% on a month-to-month basis, and we're up on an annualized basis in July relative to the previous month. And so that does suggest that labor costs remain an issue, and that those labor costs, good news for the household, they are running ahead of inflation, but it is still raises some question about this kind of continued pressure over there and whether that has broader inflationary pressures. And that's sort of the spirit of my talk today, in a way, which is the murk through which we're navigating has a lot of competing forces, and we've got kind of labor force considerations on the one side, an unambiguous negative signal here that we extracted from the labor data this morning, and then we've got inflationary concerns on the other side, and what is sort of the collective health of the U.S. economy and whether it continues to remain running hot, and what might be the implications of tariffs and the like, and all of that remains. And indeed, that is the dual mandate of the Federal Reserve, managing both the health of the labor market and inflationary pressures. And that is a tough pickle that they're in. And there's a tension between those two that is manifesting right now. And the question I think that I would pose is whether that tension is going to continue to widen out, and where does the Federal Reserve lean in terms of its decision-making as to which of those two mandates to attend to more directly. So this was a busy week. And so what else did we learn this week? Well, not only did we get a labor force read today, just now, we also got an update on GDP. We obviously had a Federal Reserve meeting. We got some inflationary data. We've had a hell of a lot of information coming about tariffs and a whole host of other things, some corporate announcements on earnings and the like. And you sort of put all that together, and there's a lot of things that are in the spirit of what I just described, sort of pulling us in different directions. Let's look at the GDP data for a moment. We learned this a couple of days ago. And so what did we find there? I think something that reinforces a bit, to some degree, the softening. I think that is sort of corresponding with what we saw this morning from the labor force data. So I want to sort of zero in on the last two bars here, quarter one of this year and quarter two of this year. There's a lot of volatility there, and partially that's driven by the implications of all of this tariff moving. So the import swings and the inventory shifts have a lot of noisy implications for all of this. And so we got kind of what looks like a reasonably healthy 3% real GDP annualized read on the back end of a pretty messy first quarter read that was actually negative. But that's heavily influenced by this black bar that you see over here, which is sort of the implication of import swings. So I would ask you to kind of see through that, average over the two, look at first quarter GDP growth, and so the first half rather, and first half GDP growth runs about 1.25% annualized once you sort of average across this, and that's a clear deceleration from somewhere where we've been. And so momentum in the economy is fading, and you sort of have to see through some of the quirks of GDP accounting to get there. But this does suggest that there is slower but still positive growth out there, and I think that is reinforcing the idea that there are things that our policymakers ought to be paying attention to. But that stands in possibly sharp contrast to the other side of their mandate. And so what else did we learn this week? We also got a read on inflationary pressures, and their preferred inflationary pressure, meaning the Federal Reserve, is from PCE, so from the consumption expenditures data. And so what I'm showing you here is core PCE data, and that is stripping out sort of volatile energy and agricultural prices. And look, this unambiguously remains an issue, and the chair was very clear about that in his press conference on the back end of their meeting on Wednesday. And so this unambiguously remains above the Fed's 2% objective. And the latest release that we got this week, plus some revisions that we received that continue to show actually a modest uptick. We're moving somewhat in the wrong direction. And so the disinflation we've seen on the back end of that kind of post-COVID environment has paused. If anything, it's kind of slightly reverted. And so that's keeping the Fed on alert in the other direction. Again, to be clear, the second half of their mandate structure is to focus on this. And we do not see this particular part of the economy continuing that downward move to the 2%. And if anything, the tariff action that we're seeing in place and perhaps the clarity that we are getting on tariffs over the last 24 hours or over the last week or so even, that may alleviate some of the uncertainty, but the uncertainty remains on the pass-through. What will those tariffs mean for inflationary pressures in this economy? And so that's adding a layer to policy risk, to be clear. And so I just want you to feel both of the sides, and that's the tension between the Fed's dual mandate. And I feel like perhaps this morning only reinforces the notion that the tension there is widening out, and it begs some serious questions about what the Fed ought to be doing in an environment like this. Let me show you a couple more things. And one is, how you view this seems a little bit in the eye of the beholder, right? And so I'm showing you this to be a little bit cheeky, to be perfectly honest, but I think it's important, right? And so there is like the vibes versus reality. So the vibe idea out there, which is sort of an interesting one, like how do we feel about the economy versus the reality that is informed by data and such, the hard data that we've been just scrutinizing. And so economic sentiment here actually diverges impossibly across partisan lines. And so if you look at sort of the red, that's how Republicans are feeling about the economy. If you look at the solid blue, that's how Democrats are feeling about the economy. It completely flips with who's in the White House. This is ridiculous. I'm sorry. It just is. And the perception gap, however, significantly complicates the policy narrative, right? I mean, so this means then that it's particularly challenging for policymakers to navigate an environment like this where people feel so angry, perhaps, about what's going on out there. But there is no way that this is a true reflection of the true economic environment. Yeah, the economic environment is volatile and maybe challenging. Perhaps the dotted folks, the independents, are the ones who are the most consistent across time. I might offer that. But it does reinforce this idea that our impossibly partisan and divided economy is finding its way into how we feel about economic activity, and also then might influence what policymakers are thinking. But again, it just sort of reinforces this idea that the murk through which we're navigating is a particularly challenging one. So let's talk for a minute about the Fed itself, and then I'll open it up to questions. So let's go here. So here's the Federal Reserve policy rate. We got an update on this on Wednesday. The chairman used the language very deliberately, I think, that the monetary stance right now, and so if you look at the very end, and you can see this sort of holding tight of the Federal Reserve rate, where it is, he used this language that it's mildly restrictive. That is sort of, a little bit on the side of hawkishness and fighting inflation. And I think that probably is only going to be reinforced with the labor data that we just got. And the officials stress data dependence. And between now and their next meeting, we're going to get another labor read. We're going to get, some significant information about inflationary pressures. And I think ultimately the direction from here hinges on how quickly inflation converges towards their target with the tariff uncertainty that I just acknowledged, without further derailing growth, or whether the labor situation consistently and persistently deteriorates from here. So let me show you what the market thinks. This is literally from this morning. So here is the federal funds futures contracts. They're trading in Chicago. And this is after this morning, what markets think the Fed might be doing in their September meeting. So that's their next meeting in a little bit more than 6 weeks' time. And they're basically looking for a better than coin flip. In fact, this has significantly increased just this morning. So the Treasury market yields have fallen significantly this morning. And this one, even since I've been looking at it, has maybe gone from about a 50-50 to about a 2/3 probability for one notch decline. And so this has shown a lot of volatility with all these data releases, with the relatively hawkish tone that the Fed had this morning on Wednesday, the data release we got this morning, which is suggesting, maybe some labor market problems. This has been pretty volatile. It's sort of gone up and down as the market has tried to digest all of this and what that might mean for Fed trajectory. After this morning's report, this has shifted back, I would say, to a significant likelihood that you're going to see a 1/4 notch decline in September. And if you look at this sort of over the remainder of the year, so I think you can see, remember where we are right now, 4.25% to 4.5%. I think the market is suggesting a couple of rate cuts perhaps for this year. But I want to be clear, like there are plenty of analysts who just think the inflationary pressure plus the tariff implications for that are going to force the Fed to actually hold tight. And you can see even this morning, the president sort of leaning in on the Fed and having a lot to say about this particular issue and asking the chairman to be more aggressive on the downside. So all of this is sort of where we are. And I think it does reinforce a challenging policy environment that they face. And so I want to show you 2 more slides. I'll show you this one to give you a sense of, what the Fed is kind of struggling with. So here is the famous dot plot. It's a little stale now because we got this 2 meetings ago, but just a reminder, like each dot here is a reflection of a particular committee member on the FOMC and where they think their own policy ought to be by the end of this calendar year, say 2025 or 2026, if you look at the next collection of dots. The light kind of Carolina blue there is sort of the median across all of them. The red dot is where the Fed funds futures market is suggesting. And so that's the information that I just showed you. So the red dot is coming from market participants. The other dots are coming from the actual policymakers. And I just want you to see, like, there's kind of a significant amount of disagreement amongst them. And in Wednesday's announcement, we had 2 governors formally dissenting against the decision that the Fed made to hold tight. And I think this is just a reinforcement of that. I mean, that is unusual. We haven't seen that for a number of decades, in fact. And I think it is just reflecting the fact that there are well-meaning decision makers who sit on that committee who are just reading this tension point and what to do about it very, very differently. And so the last thing I'll say is the following, and then I'll open up for questions. So we've got the Fed struggling with this. We've got a lot of tariff stuff that we're going to have to be digesting over the next, weeks and months from what we saw even just in the flurry of announcements last night. The labor market continues to show this struggle. We've had a massive tax and spending legislation that has come through. And so the last thing I'll say, and I'll finish here, is the following. And I have always got to use the opportunity to say something about this, which is the often untouched conversation, which is in the background of all of this, is a fiscal situation which is becoming increasingly dire, frankly. And our legislation that we just put in, and maybe some the implications of tariffs for that and some revenues that might come from there, as well as the interest environment that the Federal Reserve is going to adjudicate and ultimately have implications for this, because a lot of this debt expansion is associated with actually having to cover the interest cost on pre-existing debt. Here's our fiscal situation and the level of indebtedness that the United States has relative to the size of our economy and sort of the implications for this going forward. And the latest legislation adds a fiscal impulse clearly in the near term. There is some very favorable components there for, perhaps capital expenditure in our economy, but it significantly worsens the long-run debt profile on the opposite side. And then the interest feedback effect. So again, as we see the level of indebtedness go up, we have to pay the interest cost on that. And if interest rates are elevated, this does raise some questions about how sustainable this is. And so everything I've just described about that tension, the sort of here and now and where we are, in the background of all of this, I think are some challenging questions about when are we going to tackle this problem? And the more we kick this can down the road, the more it will eventually present itself and get in the way of our ability to correctly adjudicate policy in the near-term tensions that I've started with. So let me hand it back to you, Rob, and we can take questions from here.
Thank you very much, Christian. And as somebody who has done the briefings for a while, I can attest to the fact that the debt situation does come up in your presentations occasionally, as it does with your colleagues, Greg Brown and Gerald Cohen. So another good chance to revisit that. We are ready for your questions now. We've got a couple to work with, but we could use some more. So please go down to the Q&A function at the bottom of your screen, toward the center, maybe a little bit to the right. You can also call if you're with us on the phone today. You can email me, rob_knapp@Kenan-Flagler.unc.edu. So to the questions. Chris Faulkner McDonough says this month's corporate earnings and CapEx spending plans were stronger than expected. However, the labor market data shows possibly weaker demand for firms in sales from the household sector. What are you looking at to assess the horse race between stronger growth from CapEx versus weaker activity from slower household income and consumption?
Yeah, I mean, I think this is almost exactly the spirit of the tension I just kind of articulated. So if you look at the corporate sector, particularly some of the tech firms we heard from this year, but others too, energy and we heard from last night and others, there is some interesting capital expenditure that's going on. And I want to be super clear, like there's no reason for us to imagine that there aren't really compelling growth opportunities that both firms and our country here in the United States enjoy. And technology is clearly one of them. And that was part of what I think you saw coming out of the tech space. And so there are definitely, some tailwinds that are out there. And I think the equity market clearly reflects that. It is very richly priced and it's imagining some exciting things happening, particularly from some firms. But the reality is we've got, some labor market weakness. There's certainly plenty of sectors that are maybe not hiring, perhaps not firing as well, but it seemed to be a little bit more in the wait and see. I think at the end of the day, what are we looking at? We're looking at this tension between what additional signals of weakness do we see in the labor market versus how does this manifest in price acceleration? And I'm particularly interested in those two pieces of information because those inform that tension point that the Federal Reserve is struggling with.
Okay, thank you. This one's from Kirk Redmond. Morning, can you share how the recent productivity data is trending? Anything to watch out for?
Yeah, that's an interesting one because productivity is the magic, right? I mean, that's what makes everything happen. That's how you can sort of grow sustainably and fundamentally change an economy over the long run. But there are funny things that can happen over there. I mean, in the short run, you can get sort of cyclical movements in productivity because you're trying to do more with less. That's not that exciting, to be honest. I think what we're really interested in, and the answer is honestly TBD, is what are the long run real productivity enhancements associated with technology? Is something like AI or other technological advancements going to fundamentally change how we do business and then ultimately manifest in real productivity data? And so aside from the short run vicissitudes associated with cyclicality, that takes longer to see. And so I remain pretty optimistic, and certainly the CapEx that you see amongst firms that was alluded to in the previous question is related to all of that, but we're not we can't see it yet, and unfortunately, productivity takes a long time to show up in the data, and so that's that I think is pretty exciting, but it's hard to measure at present.
Okay, we'll segue with another, is it showing up in the data question? And this is one we've seen before, I think people are interested in. Have all the layoffs within the federal government made it through to the employment data?
Yeah, probably not, to be honest. I mean, I think you can see some of it, but I don't think you necessarily see all of it yet. And so that's a sector worth watching. And again, these things get revised over time. We just saw a massive revision to today from the previous month. And so I think we'll probably need a couple of months, 3 months moving average, maybe, to really start to feel like we understand what's happened in the federal government as a consequence of some policy choices made there.
And along that same line, there's been a lot of talk about when higher tariffs would start to show up in consumer prices. And I think there was an acknowledgement that there was going to be a lag. This morning, I think I read somewhere that it could be January before we really start to see those hit. Where do you see that landing?
Yeah, this is a tricky one because there's actual tariffs and then there's tariff uncertainty, right? And so ironically, what we may be enjoying, if I can use a word like that right now, is a resolution of some uncertainty. Again, I'm pretty uncomfortable with the tariff strategy. I'll just be pretty transparent about that. But at least if we get some resolution and uncertainty on that, that may allow people to understand the environment in which they're operating and start making decisions accordingly for supply chain arrangements or CapEx or what have you. But the actual implications of those tariffs have not really shown up yet. There's a little bit here and there. So if you really start parsing like the CPI data and other stuff, you can see some pieces where prices have accelerated, but it hasn't shown up dramatically, I would say, in the broad-based price data yet. And that's for a host of reasons. One is many of the tariffs actually haven't been institutionalized yet, certainly not the magnitudes that maybe are going to be coming in place now. I mean, we're looking at a 15 to 20% average tariff across all of the imports in the United States, like now firmly in place as a result of even things that were, executed last night. And that's going to take a little while to show up. But the second thing is firms have been eating some of this. So just to be clear, foreigners and foreign firms do not pay these tariffs. The American economy pays the tariffs. And that gets disaggregated into either the firms eating this in their margins or passing this along to their customers. Some firms have been eating this. As this persists, it may continue to get passed on. And that's going to take a little while for us to observe. And so I think that's a little bit the spirit of what I was describing, which is the disinflation that we've enjoyed post-COVID, kind of uncertainty about how that's going to pass through in the CPI data. And it'll take a little while for the reasons I just described.
Okay. It's 9:29. I've got 3 more questions. So
Okay.
I'm going to try and throw them all at you and we'll
Sure.
see what we can do. To what extent is the recent slowdown in job growth a result of tighter immigration flows? And are we beginning to feel the labor supply constraints of policies enacted?
Yeah, I think the answer is some of that invariably is associated with labor supply. I was trying to make that point a little bit, but it's difficult to parse that out. And the immigration that we have, the immigration data we have, are noisy and kind of slow moving, right? And so I think what the point is, there's definitely some labor demand slowdown that's clearly taking place. We know that in some sectors, but there's also some labor supply issues, and the immigration component is one of them. And that's a really important part. Like a lot of the job growth that we enjoyed on the post-COVID boom was actually associated with immigration. And whatever you might think about that from a political standpoint or a social standpoint, that's just the reality. And so I think that tension is going to be quite present. And invariably, a piece of this is associated with a slowing labor supply as a consequence of reduced immigration flows. But definitively saying how much comes from X and Y is going to take some time in the rearview mirror, regrettably.
Okay. Do you feel like we could potentially move toward a perfect storm of stagflation with this would those tariffs, I'm assuming we're talking about the ones that have gone off this morning, would those tariffs trigger this perfect storm?
Yeah, trigger is a strong word, but I think the risk is definitely there. And so a tariff is, not unlike a kind of external supply shock. And, it's different in its origin, but it mirrors or rhymes perhaps with the 1970s, where you have this kind of external shock that hits both economic activity and price pressures at the same time. And so there's a risk here that those negatively affect firms' willingness to engage in business activity, as well as the price pressures we face. And so it has a risk of creating some stagflationary concerns. I would put it that way.
Okay. Last question goes to Dan Barkin of Business North Carolina, who asks, are you concerned about the quality of government economic data?
Yeah, deeply, actually. I think that's a really important point, Dan. And the reality is we have underfunded our data efforts. They're really important. And we can already see that some compromises or, concessions to data acquisition have been made. And I fear that runs the risk of deteriorating our data quality. And I want to just remind you, where did this come from? I mean, we built a data acquisition machinery over, the last century plus. And even just measuring things like GDP and such came from a time in the Great Depression where we didn't even know where the hell we were, let alone where we might be going. And we built this machinery, and it's expensive, sure, but it's incredibly important because it helps us understand as policymakers where we are. It helps firms understand where they are as they make their own business decisions and resource allocations. And we are underfunding our data construction, and that is risky.
Okay, very good. That sounds like the last word to me. Thank you very much, Professor Christian Lundblad, for taking a shot on a very difficult morning to tie everything together. Appreciate your insight and analysis. Thank you also to the attendees. We appreciate your questions. They always make us smarter by answering them. Thank you for those. So for those of you in the media who are out there, we'd love to continue the conversation. If you have questions for Christian or any of our other experts on any subjects you might be working on, please let me know. rob_knapp@Kenan-Flagler.unc.edu. For everybody out there, we hope you'll visit the website. A couple of things to note. We have put up a recent spotlight on our grand challenge, which is the skills gap and how AI relates to that. So several things to read on there. We hope you'll take a look. We hope you'll also keep an eye out for a couple of new pieces coming up that are part of our collaboration with Fifth Third Bank, Empowering American Cities. Those aren't up yet, but you will see those before the end of the month, I believe. So keep an eye out. And then I wanted to pass this along as well. We have our annual event coming up, Frontiers of Business, and I will show you a little graphic here. It is coming up on October 9th. We hope you will consider coming to it. I met some people from the briefing last year, hope to meet a few more this year. We're going to be addressing our grand challenge, Bridging the Skills Gap. We will have speakers, we will have panels. I'll probably talk a little bit more about that to you next month, but you can find all the information we have for it right now if you go to the website frontiers.unc.edu. Information on the conference as well as how to register, and we have a discount code for you, 10% off registration. You can see it there. It's August briefing. So hope you will consider it. And I will remind you again about that next month as well. Okay, I think we've covered it all. We appreciate you being here this morning. We will see you again on September 5th. We hope to see you then. So again, thanks for being here and enjoy the rest of your Friday.